Welcome to The Explainer. Today, we're going to break down a really huge shift that's happening in the world of investing in India. It's a kind of quiet revolution, but it could totally change how you think about growing your wealth. All right, let's just get right to it with a pretty direct question. When you think about your investments, all that money you've worked so hard for, is it possible you're actually paying more for less? To answer that, let's start with the traditional way of doing things, active mutual funds. You know the ones I'm talking about, right? They're run by these expert fund managers who promise to use all their skills to pick the best stocks and beat the market. But, well, it turns out there's a pretty big problem with that promise. 73%. That is a staggering number. Let that sink in for a second. That's the percentage of large-cap active funds in India that failed to beat their own benchmark index over a 10-year period. I mean, we're talking about nearly 3/4 of them not even doing the one job they promised to do.
And look, this isn't just a fluke or a one-off thing. It's a pattern we see everywhere. While 73% of the big company funds underperformed, it gets even worse for funds that focus on small and mid-sized companies. A shocking 82% of them fell short. This holds true no matter how you look at it. Different time periods, different types of investments. Even those so-called top 10 funds that get all the attention have mostly just managed to match the market, not really beat it.
So you have to ask yourself, right? If the vast majority of these funds aren't actually outperforming, why on earth do they cost so much more? Well, that brings us to the hidden costs that are quietly dragging down your returns.
The biggest culprit here is something called fee drag. The expense ratio for an active fund, that's the management fee you pay every year, is often 2, 3, sometimes even 4 times higher than what you'd pay for a passive fund. You're essentially paying this huge premium for that human expertise.
And this is where it gets really painful, because it's like compounding in reverse. That little fee difference might not seem like a big deal each year, but it adds up. Over a decade, it can literally eat up around 20% of the money you first invested. Just gone.
The second problem is this idea of over-diversification. You see, you'd think an active fund is making a few really smart, concentrated bets. But in reality, a lot of them own 60, sometimes even 120 different stocks. As one analysis perfectly put it, this is not diversification, but throwing in the kitchen sink. When you own that many stocks, you basically just become the market index anyway, except you're paying much, much higher fees for it.
So, because of all these issues, a really powerful alternative has started to take over. It's a revolution that is fundamentally changing the investing world.
And that brings us to passive investing. The concept is so simple, it's beautiful. Instead of trying to beat the market, these funds just aim to be the market. They automatically track an index, like the Nifty 50, holding all the stocks in that index in the exact same proportions. There's no star manager, no stock picking, it's just pure automated replication.
You know, a great way to think about it is like the driverless car of finance. We're seeing automation everywhere else, right? It's all about improving efficiency and removing human error. So why should our financial markets be any different?
And this is not some small niche idea. It's a massive global phenomenon. In big economies like the US and China, passive funds already make up more than half of all mutual fund assets. India, sitting at around 17%, is still in the earlier stages, but you can see exactly which way the wind is blowing.
Okay, so let's zoom back in on India. How is this global revolution actually taking hold right here at home? The growth has been, well, nothing short of explosive. Back in 2018, passive funds were just a tiny 5% of the market here. Today, that share has rocketed to about 17%. It's more than tripled in just a handful of years. The momentum is just undeniable.
But here's where it gets really interesting. Who is actually driving this growth? When we look closer, we find it's mostly the big players, the institutions. They've already gone big on this shift, with passive funds making up 30% of their assets. But for retail investors, people like you and me, it's still only 5%. And that gap, that right there represents a massive opportunity.
But the story doesn't just stop with simple index funds. The whole world of passive investing is evolving. It's actually getting smarter.
And this is where something called smart beta comes into the picture. The easiest way to think about it is as a hybrid. It's a bridge that connects the low-cost, automated world of passive with the strategic thinking of active investing. These funds use simple, preset rules to target specific, proven drivers of return, like focusing on quality companies or stocks with momentum.
So here's how it works. First, you decide on a factor you like, let's say quality. Then you create simple rules to define it, like only invest in companies with low debt. Based on those rules, a new custom index is built. And finally, a low-cost ETF is created to track that new, smarter index automatically. It's strategic, but it's still hands-off and passive.
So, let's bring this all together. What does this massive shift towards passive and now smart beta actually mean for you and the future of your money?
30%. That's the potential market share that experts think passive funds could reach in India within the next 5 to 7 years. That's nearly double from where we are today. This isn't just a fad, it's a fundamental change in the entire investment landscape.
And that really leads us to the final big idea here. As this universe of passive options just explodes, from simple Nifty 50 trackers to all these complex smart beta funds, the skill you need as an investor is changing. Maybe the challenge is no longer about finding that one-in-a-million manager who can beat the market. Maybe the real skill now is about you choosing the right market or the right strategy to be in the first place.